Your salary can impress people, while your net worth is still paycheck powered. Picture two men in their early 50s. Marcus and Daniel earned similar money. They both worked for decades. They both look stable from the outside. But one of them still needs his paycheck to push every dollar uphill. The other has crossed enough thresholds that his assets have started doing visible work. That's the part of compounding most people misunderstand. On a chart, wealth looks smooth. Save, invest, wait, and the curve bends. In real life, it doesn't feel smooth. It feels slow, frustrating, and almost invisible. Then a few tipping points get crossed, and the same dollars start behaving differently. The Federal Reserve's 2022 household data shows why salary alone can mislead you. For families aged 45 to 54, median income was about $91,900. Median net worth was about $247,200, but mean net worth was about $975,800. For ages 55 to 64, median income was about $81,900, while mean net worth was about $1.57 million. Same age bands, very different wealth pictures. So this video isn't a promise that your net worth magically explodes at one exact number. It's a map of 5 moments when money changes jobs. First, cash flow stops leaking. Second, invested assets become visible. Third, ownership starts to matter. Fourth, capital can add more than your annual contributions. Fifth, the job changes from pressing the gas to protecting the snowball. That unevenness isn't just a feeling. The Fed's median net worth for families aged 35 to 44 was $135,600. By 55 to 64, it was $364,500. But the mean moved from $549,600 to about $1.57 million. The median shows the middle household. The mean shows how much the top pulls the average upward. That's why the smooth curve can be emotionally misleading. The first tipping point is the cash flow flip. It's not glamorous. It's not a stock chart. It's the moment income finally survives the month. Because net worth doesn't compound from income. Net worth compounds from income that survives fixed costs, debt payments, taxes, family support, insurance, and catch-up needs. In the Fed data, debtors had a median payment-to-income ratio of 13.4%, and 6.5% of debtors had payment-to-income above 40%. Those numbers don't mean every household is in trouble. They mean payments can quietly take first claim on the paycheck before investing even enters the room. This is where Marcus starts to understand why his good income still feels stuck. His salary is visible. His true surplus is hidden. A raise hits the account, then housing takes a piece, debt takes a piece, insurance takes a piece, family help takes a piece, and catch-up savings gets whatever survives. Salary impresses people. Surplus buys choices. This is the first reveal, and it needs to land early. High income and compounding power are not the same thing. Income is the river. Surplus is the water that actually reaches the asset tank. If the river is large but every channel leaks before it reaches the tank, the household can look successful while the asset engine stays dry. That's why Daniel can start pulling away from Marcus before he earns more. Daniel's difference may be boring. Fewer fixed claims, less consumer debt, more automatic investing, a cleaner line between helping family and becoming the family's backup bank. The first ignition point is not a heroic investing move. It's a monthly cash flow system that keeps sending fuel to the engine. The second tipping point asks a different question. What do you actually own? In 2022, 66.1% of families owned a primary residence. 58% had direct or indirect stock ownership. About 54.3% had retirement accounts. But direct stock ownership was 21%, privately held business ownership was 20%, and business equity ownership was 14.6%. Ownership is not one thing, it's a ladder. Now bring back the ignition gauge. At a small balance, even a strong return feels small in dollars. In a simple 7% example, $50,000 produces about $3,500 in a year. $100,000 produces about $7,000. $250,000 produces about $17,500, but $500,000 produces about $35,000. At $1 million, the same 7% is about $70,000. That's why $500,000 becomes a useful anchor number in this story, not because everyone needs the same target, not because 7% happens every year, but because the dollars become visible enough that the account starts to feel like a second worker. The question changes from how much can I add to how much can the base add with me. Compare the feeling at $100,000 and $500,000. At 7%, the $100,000 account adds about $7,000 in a year, useful, but still smaller than many serious savers can add themselves. At $500,000, the same assumption adds about $35,000. Now the account isn't just sitting there, it's competing with a high annual savings rate. This is why the first real engine can feel late. The engine may have existed for years, but it wasn't loud yet. A small portfolio can be doing exactly what it should and still feel disappointing because the dollar change is small. The viewer should not hear that as failure. The early years build the base. The later years reveal what the base can do. This is also where ownership access matters. The Fed found that 58% of all families had direct or indirect stock ownership, but among the bottom half by usual income, the figure was 34%. Among the upper middle group, it was 78%. Among the top decile, it was 95%. The asset engine is not evenly distributed. And ownership size matters too. Among families who held stock directly or indirectly, the conditional median holding was $12,600 in the bottom half income group, $53,200 in the upper middle group, and $608,000 in the top decile. That doesn't prove stocks caused the gap. It proves the base is different. And a different base means the same percentage return does a different job. This is the part that keeps the episode from becoming a motivational speech. Ownership isn't just a mindset. The data shows two separate gates. First, whether the household owns the asset at all. Second, how large the holding is if the household gets through the gate. The ignition gauge moves only when both gates start to matter. So when people say make your money work for you, the real question is much less poetic. What balance sheet item is supposed to do the work? A retirement account can do some of it. A broad stock holding can do some of it. A private business can do some of it. But if the paycheck is the only engine, the whole machine still depends on labor. The ownership story gets sharper with businesses. The Fed reported that 20% of families owned a privately held business, while 14.6% held business equity. Among those with business equity, the median value was $90,000, but the mean was about $1.62 million. That's a giant gap, and it points to the midpoint turn. Some wealth comes from wages, but some wealth comes from owning engines. This is where the video changes texture. Personal finance usually talks about saving harder. Business filings show another mechanism. Productive assets can grow revenue, produce cash flow, reinvest, reduce debt, repurchase shares, pay dividends, and increase the owner's claim over time. That's not motivation, that's a machine. Use Apple only as a filing example, not as a recommendation. In its 2014 filing, Apple reported net sales of about $182.8 billion and net income of about $39.5 billion. In 2024, net sales were about $391 billion and net income was about $93.7 billion. Meanwhile, split-adjusted basic shares moved from about 24.3 billion to about 15.3 billion. Bigger business, fewer shares, different owner claim. The filing also shows owner return levers. In 2024, Apple reported about $94.9 billion in common stock repurchases, about $15.2 billion in dividends and dividend equivalents, and 499 million shares repurchased. Again, this isn't buy Apple, it's look at how ownership can show up in real documents. That's the ownership multiplier. Wages pay once. Productive assets can keep working after the hour is over. Some businesses fail. Some returns disappoint. Some buybacks are poorly timed. So the point isn't blind optimism. The point is that ownership changes the question from how much can I earn this month to what am I allowed to own while I keep earning? That definition matters. Productive asset doesn't mean a hot tip. It doesn't mean any single company, any private deal, or any story with a big future attached to it. For this episode, productive asset means something with a real claim on cash flow, earnings, property, or business value. The details can be complicated. The first question is simple. Does this thing have a real engine behind it? Now the path is visible. Labor creates income. Surplus converts part of that income into ownership. Ownership creates a claim. The claim may grow, shrink, pay out, or disappoint, but at least it has a job beyond sitting in the checking account. That's the bridge from paycheck-powered progress to asset-powered progress. Now the fourth tipping point becomes obvious. The capital crossover is the moment your money can add more than your annual contributions. The formula is simple. Annual contribution divided by assumed annual return. If you contribute $25,000 a year, a 5% assumption gives a crossover balance of $500,000. At 8%, it's $312,500. The formula is useful because it's personal, but the return assumption is uncertain. For realistic inputs, the 2026 IRS limit for employee deferrals in many workplace plans is $24,500. With the regular catch-up, many people age 50 and older can reach $32,500. Ages 60 to 63 have a higher catch-up amount. Those limits don't tell you what to contribute. They simply show why $25,000 or $35,000 can be realistic high savings examples for some households. Put Marcus and Daniel back on screen. If Marcus has $100,000 invested and the example return is 5%, the account adds about $5,000 in that year. If Daniel has $500,000 invested, the same 5% adds about $25,000. Same return, same contribution target, different engine. That's why the ignition gauge isn't about ego, it's about which engine is powering the next dollar. The equation also explains why different households feel different levels of acceleration. If someone adds $10,000 a year, the 5% crossover is $200,000. If someone adds $50,000 a year, the 5% crossover is $1 million. Bigger savers need a bigger balance before capital outworks their own saving. Smaller savers may feel the crossover earlier, but with smaller dollars attached. This is why the capital crossover should not become a bragging line. It's not "I made it," it's the source of progress is changing. Before the crossover, the person does most of the lifting. Near the crossover, the person and the assets lift together. After the crossover, the assets can become the heavier lifter, at least in normal or strong years. Then comes the fifth tipping point, the protection flip. Once the dollar amounts get bigger, the old game can become dangerous. A 10% bad decision on $25,000 is painful. A 10% bad decision on $1 million can move a retirement date. The goal is not to keep pressing the gas forever. At some point, the wealthy move from acceleration to guardrails. Market history makes that clear. The S&P 500 total return was down 36.55% in 2008 and down 18.04% in 2022. Then it returned about 26.06% in 2023, 24.88% in 2024, and 17.78% in 2025. Strong years are real, bad years are real too. If the script only shows the smooth curve, it hides the emotional test. Protection doesn't mean fear. It means the bigger the base, the more every mistake has zeros attached. Concentration risk matters more, tax timing matters more, cash buffers matter more, withdrawal timing matters more, behavior matters more. The same confidence that helps someone build wealth can become a risk if it refuses to slow down. This is where averages can trick the ear. A long-run return can be useful for planning, but nobody lives inside the average. They live through the order. A bad year near a withdrawal, a job loss, a big purchase, or a panic sale can matter more than the long-term chart suggests. The protection flip is about respecting the order of returns, not denying that returns exist. So the guardrails should be practical. How concentrated is the portfolio? How much cash prevents forced selling? Which tax years need attention? What rule decides withdrawals? Who gets a second look before a large transfer leaves the account? The point is not to make wealth boring. The point is to keep one bad decision from undoing 20 good years. The fraud numbers are one warning light. In the 2024 FBI IC3 report, people aged 50 to 59 reported about $2.5 billion in losses, and people 60 and older reported about $4.8 billion. Investment crime losses across reports were about $6.57 billion. These are reported losses, not every loss, but the direction is obvious once balances grow. Protecting the pile becomes part of the job. So the protection flip asks different questions. Can one holding damage your plan? Can one tax year surprise you? Can one scam bypass your checks? Can one bad market year force you to sell at the wrong time? These aren't exciting questions. That's why they're useful. Excitement isn't the same as control. Now the open loop closes. You don't need to be at all 5 tipping points today. You need to know which game you're playing. The Net Worth Ignition scorecard has 5 checks. 1. Monthly true surplus. 2. Invested assets times a conservative return range. 3. Productive asset share. 4. Your capital crossover balance. 5. Guardrails. Use it like a framework, not a personality test. The first check tells you whether the engine has fuel. The second tells you whether the invested base is large enough for returns to show up in dollars. The third tells you whether you own anything that can work without another hour of labor. The fourth tells you when capital can outwork contributions under an assumption. The fifth asks what could make you give it back. If true surplus is weak, the job isn't chasing returns, the job is finding fuel. If the invested base is small, the job is consistency. You're building the engine. If ownership is low, the job is understanding what assets you actually own. If capital can add more than your labor, the job is allocation. And if wealth is already accelerating, the job is guardrails. The audit is intentionally simple. Surplus builds the base. The base turns percentages into dollars. Ownership gives those dollars something to claim. The crossover shows when the base can start carrying more of the load. Guardrails help keep the progress from being handed back. That's the whole episode in one line. Fuel, engine, ownership, crossover, protection. That's the final payoff line. The question is not, am I rich? It's which engine is powering my next dollar. If the answer is still the paycheck, that's not failure. It's simply the stage you're in. If the answer is partly assets, the next job is to understand the machine. If the answer is mostly assets, the next job is to protect the machine from yourself, taxes, concentration, scams, and bad timing. If this helped, like the video, comment with the tipping point you're closest to right now, and subscribe for the next plain English money breakdown. Thanks.